The macro backdrop is excellent for gold. It's had a very nice move from 1600 to 3200, but I still think you've got a multi-year thesis on physical gold demand being very strong in the market and a rising gold price over time. But the fattest pitch for me, Stein, is really in the equities. Silver is different than gold. So gold is money. Silver, they call it poor man's gold for a reason. We've started to see silver break out recently, getting to potentially 52-week highs, $36, $37 an ounce. And concurrently, you've seen the junior resource stocks finally wake up from a 4 to 5 year slumber.
All right, today we're having a chat with Michael Gentile, of course, a man who wears many hats, co-founder of Bastion Asset Management, also a strategic investor in junior mining. Great to have a chat with you today, Michael.
Great to see you, Stein.
So many topics I would like to touch base on: gold, silver, copper, mining industry as a sector in general. So I suppose we can start there. Are you seeing this opportunity as well, where supposedly there's a lot of underinvestment in strategic commodities, like, for example, copper, definitely a material we need for the future, and there's a sort of drain in the industry of capital, but also people and knowledge leaving it by just aging out, and not a lot of inflow at the bottom. Is that something you're looking at currently?
100%, Stein. I mean, I've invested in commodities since the mid to late 90s. So what I've learned in the commodity business, how to make money in this business, is you invest in commodity cycles when the industry is starved of capital, after periods of dramatic underinvestment, when sentiment is poor and your outlook for the commodity is positive. That's typically the perfect backdrop for investing. It's what got me investing in gold, in particular in 2015. I invested in oil and gas way back when, in 1997, 98. People thought oil was going to go to $5 a barrel. It was at 10 at the time. Instead, oil went to 145. So I've learned to be contrarian in this business. I've learned to invest when the industry is starved of capital. The capital starvation you're talking about, what that does is you have no exploration, you have no new discoveries, you have no investment in new production, whatever commodity you're in. And that typically leads to supply shortfalls in the future. That happened in oil in the 90s, happening in base metals and gold now today. And then when you see an uptick in demand, you have no supply or declining supply and increasing demand. That's what leads to explosive moves in price. And typically, if you're investing at a point where there's pessimism or negativity, the valuations of the companies themselves you're buying also are very, very low. So you have this beautiful mix of low valuation, rising commodity prices, and increasing investor interest that lead to higher cash flows, higher multiples, and much higher stock prices. So I've been really excited about gold since 2015. I started investing heavily in juniors, my own capital, in 2018, to the point where I'm the largest investor in 25 to 30 juniors. I truly believe in that thesis right now, and I see the stars aligning nicely. It's been a lot longer than I thought. It's taken a lot longer to have these stocks move up. The commodities have been excellent, but I think the stars are aligning nicely for an explosive moves in the equities as well here.
Great overview there, Michael. Really well put. Talking about fat pitches in the mining space, where you see that lineup of a rising commodity, but also a bit of perhaps underappreciated sentiment in that space. Where are you currently seeing that most opportunity, those fat pitches coming by?
Yeah, so I've been really bullish on gold. I remain very bullish on gold for the last several years. The fat pitch, the macro backdrop, we can get into that a bit later in this call if you'd like, but the macro backdrop is excellent for gold. It's had a very nice move from 1600 to 3200, but I still think you've got a multi-year thesis on physical gold demand being very strong in the market and a rising gold price over time. But the fattest pitch for me, Stein, is really in the equities. If you look at GDXJ, which is a proxy for the small mid-cap gold producers in North America, it's trading around between $60 and $70 a share. At the last high, when gold was $2,000 an ounce, it was between $160 and $180. So you're still 50 to 60% lower than you were at the last peak, yet the gold price is 50 to 70% higher than the last peak. So you don't have to be a financial wizard to understand that that's probably a relationship that has to readjust. The margins the gold equities are making right now are phenomenal. So you've got a really good backdrop for physical gold prices, while valuations and sentiment in the gold space still remain remarkably low. It's not mainstream. Retail investors have not come back in the space. It's not on CNBC. So you're still very, very early in the sentiment cycle, yet the fundamentals are phenomenal. I've never seen this in my 25-year career, Stein, in terms of usually this kind of sentiment is coupled with low prices and a hope of a rebounding commodity price. Here we have very robust prices, good margins, very healthy companies, but the stocks are still incredibly cheap. So that's probably the fattest pitch, because other fat pitches, you're hoping for things to happen. Here you have all the cards or all the information in your hands, and yet you're not getting paid yet, which to me is why I keep on doubling and tripling, quadrupling down on my bets on the junior gold equity. So I like that space as well. Copper is another one that I quite like. Been a little bit more hesitant on copper just because the economic outlook is still a bit cloudy. So they used to call copper, Dr. Copper. So copper is very, very sensitive to, short-term economic sentiment and short-term economic indicators. What's been remarkable recently is that copper is breaking out above $5 in a world where the economic uncertainty is still very, very high. And I've had a couple of conversations about this recently. What I'm seeing here is that there is no supply going out 5, 10, 15 years. We're dramatically short the amount of copper that we need to electrify the grids, electrify the EV vehicles, and the electrification in general of the economy. And so for the first time, probably in my career, copper is trading now more off of long-term price signals versus short-term, which is quite interesting. So I have a very bullish outlook for copper long-term. I think we need 5, 6, 7, maybe even $8 copper to justify the billions of dollars of capital that go into building new copper mines today. In the short term, a little choppier. But again, the equities, at least on the junior side, the junior resource developers are still trading at very, very low multiples, despite the fact that we need their supply. So gold and copper have been where I spend most of my time. Other commodities are a little more niche. And so in that space, I'll really focus on the project itself, looking for really high quality projects that can get built in almost any commodity environment. And if I get a tailwind behind me, I'm very happy to take the extra benefit of the commodity price. But gold and copper are the two areas I spent most of my time in the last 5-6 years.
Excellent. And so many threads to pull there again, but let's start with the first one, gold. Of course, you outlined, you had a thesis back in 2015 for going long. Since then, we've seen an absolutely tremendous return already. Are we getting into the territory where perhaps gold is a bit overbought? It might be pulling itself a bit up too high? Or do you think the thesis is still intact and we're bound over the long term to go substantially higher?
Yeah, so in 2015, gold was $1,100 an ounce. My thesis really was maximum negative sentiment then. People thought gold was going to go below 1,000. They were calling it a relic. If you recall at the time, companies like Barrick, Freeport, Teck were all upside down. Their balance sheets were so bad, people were questioning their liquidity and solvency. So when the biggest mining companies in the world are talked about going bankrupt, and gold sentiment was just so terrible. That was an example of the classic example of buying the negative sentiment. I said gold is not a relic. I believe gold was going to reassert itself in the monetary supply. It was very, very early in that thesis, but that was maximum negativity. So it was more just going, avalanche chasing or smelling blood in the water where you saw that negativity that there was due a rebound. But my thesis in 2015 and more in 2018 and beyond has been there's just too much borrowing and too much debt by the governments around the world. So if you look at what's happening now, Stein, is that gold is reasserting itself as money. Investors have lost confidence in the ability of the US and European countries and Japan and others to repay their debt in fiat currency that's worth anything at all. And so for 67 years, gold had sort of been pushed aside. They decoupled from the Bretton Woods, they decoupled from the gold standard. I think investors now, central banks and other investors are saying, no, the only currency that can't be printed, the only money that cannot be just printed at will is gold. You're seeing on the central bank's reserves have gone from about 6% gold to 15 to 20% gold. US dollar, holdings by foreign exchange buyers. It used to be 95% of all treasuries in the US were held by foreign buyers about 10 years ago. Today it's down to low 70s. So you just see that trend of selling US treasuries, selling the US dollar as a reserve asset and replacing it with gold. And you look at other currencies that could be bought, the euro, the yen. Most of those currencies their houses are just as bad a shape as the US. So you're not going to trade one bad paper currency for another one. So that's why I believe gold's a mega trend. We're going to see consistent diversification out of paper currencies, i.e. the US dollar, into physical gold. Look at all the buying the last 2 years. It's been all central bank buying. We have not seen the financial markets participate in that. So that's why I believe when central banks decide to buy physical gold, they don't care whether it's 3,300 or 3,100 or 3,400. They have a program of allocation to physical gold, whereas hedge funds and financial markets will be much more sensitive on should I buy today or next month, a little more tricky. So to me, that perma trend of central banks diversifying is very powerful. And I don't see any signs of fiscal responsibility. Elon Musk was hired to put the US government spending in order and cut expenditures, and he was gone 4 months later. And we're passing a big, beautiful bill, which is big and beautiful for growth in the US, but also big and beautiful for deficits. So I don't see any fiscal sanity returning to any of the G7 countries, to be honest. So in that case, I think we're going to see more and more interest in physical gold. So that's where I see it. And to make a case, I don't think we need to see gold go to 5,000 or 10,000 to have these equities be phenomenal performers. If gold just stays sideways from here, I think the equities will increase dramatically in value. I mean, 100, 200, 300% is probably likely because the market's still pricing in gold prices in the equities in the mid 2000s. We're not even close to pricing in $3,000 gold. So we don't need gold to keep going here to make money in equities, but I do think physical gold will continue to appreciate over time.
Yeah, wow. Really well put, Michael. Thank you. And also, as a side note, completely agree with that thesis. Talking about gold equities, you outlined that they're historically seen very cheap. Want to counter that argument a bit. Of course, we are seeing companies that have risen significantly less in share price than their NAV has due to the gold price increase. Is that a part of that also just mismanagement, where companies aren't really able to keep their cost under control, and therefore they shouldn't have risen as much?
It's a good point. If you look at 2020, post-COVID, is the last time we really had explosive moves in the junior resource sector and explosive moves in the gold sector. If you look what happened then, gold went from $1,600 an ounce to $2,000 an ounce very, very quickly. So a rapid increase in gold price, and the stocks all responded like they typically have in previous cycles, which is if your gold price is rising rapidly, your margins should also be rising rapidly, and it's a leveraged business. If your costs are $1,400 an ounce when your gold price is $1,600, you're making $200 per ounce margin. If it goes to $2,000, you're making $600 per ounce margin. That's a tripling of your margins. Not many companies can triple their margins in 1 or 2 quarters, right? So that's why the stocks do very, very well. So the stocks rallied. There were explosive moves. Many junior stocks went up 500 to 1,000% in very short periods of time. And then what happened? Well, 2021, 22, 23, we saw a period of hyperinflation. So the costs went from, let's say, $1,400 an ounce in 2020 to $1,800 to $1,900 an ounce. And so all the margin that you were supposedly going to make got eroded by inflation. And that's why you had this big deception from investors that, look, if you guys can't make money when gold's hitting new all-time highs, you're never going to make money. That was $2,000 an ounce back then, right? So Newmont, I remember Newmont was at the Bank of Montreal mining show a couple of years ago, was making a new 52-week low as gold was making new highs. Because eventually we just don't trust you anymore to make money. But that was a period of extreme hyperinflation that everyone was fighting globally. And so yes, a lot of that margin increase got eroded away. You fast forward to today, gold's gone from about $2,000 an ounce to $3,300 an ounce. That's $1,300 margin expansion from 2020. And costs in general are much more muted. We're still seeing, you're going to constantly see 4 or 5% inflation. That's just because gold price money and inflation goes up, the gold price, cost to produce gold is going to go up. But that's $1,200, $1,300 of margin. You're very unlikely to see $1,300 of cost inflation in the gold space in the next 2, 3, 4 years. So that the inflation, the margin expansion we see now is much bigger than it was in 2020, both on a dollar basis and a percentage basis. And I think it'll be a lot more enduring. So why the gold equity is underperforming? It's because investors still don't believe. They still don't believe that the margins, but every quarter that goes by where Agnico or Newmont are producing massive amounts of free cash flow, buying back stock, paying dividends, have net cash on their balance sheet, it's that wall of worry, right? And so you're going to see every quarter that goes by that gold sticks above $3,000 an ounce. Generalist investors are not going to be able to ignore the massive amount of free cash flow and the profitability of these companies are, especially in a world where everything else is a bit uncertain. I mean, gold is one of the only industries that's not affected by tariffs. There is no economic overhang on gold. There's no tariff overhang on gold. So this, if you're a generalist investor looking for free cash flow, earnings growth, multiple expansion, this is where the gold space has the most attractive attributes right now. So that's one. And then two, I'm involved with a lot of juniors where the economic studies that come out, you talked about NAVs, put out a few PEAs recently in some companies where I'm on the board of directors. We're forced to use the consensus gold price when we put out our studies. So that's $2,500, $2,600 an ounce gold today. So you put out a study at $2,600 an ounce gold, but you're supposed to and forced to use current costs. So you're using current costs, but a gold price of $2,600. So that's why we see the spot price and the consensus price. So I think investors, even looking at the consensus gold price, $2,600 an ounce, look, wow, these companies are really, really cheap. If you run spot, they're incredibly cheap. And so you're being very punitive when you run current costs against a lower gold price. So if you do that math as an investor, you see then again how much even cheaper these stocks really are versus the market.
Yeah, great overview, Michael, there. And talking about those companies that you're a strategic investor in the junior space, not them specifically, but do you truly get leverage to the gold price if you're investing in a company that isn't producing any gold but does have gold in the ground?
So theoretically, yes. So I'm invested in and bet a lot of my money personally on this. You're investing in companies. I've been able to buy the last 3-4 years, companies trading at $5, $10, $15, $20 an ounce Canadian in the ground valuation for gold. when the gold price is, $4,500 Canadian. So you're getting incredible value there. But you're right, there's a long way to go from a resource in the ground to producing asset. But theoretically, you have massive leverage. Where am I seeing that? I'm seeing that in other jurisdictions other than Canada, where you have a little shorter timeline to production, let's say West Africa, which is very unpopular right now. But I can tell you it's extremely popular for physical buyers of gold. So you're seeing the Arabs, the Chinese, the Russians, even the local Africans coming in, trying to buy some of the companies. I'm involved in public companies or other companies in West Africa saying, look, I can buy it for $100 an ounce in the ground, say close to production. I can produce it for $1,200 ASIC, and I put some capital to get off the ground. So maybe all in, I'm producing it for $2,000 an ounce, including my capital costs. And physical gold is $3,300. So that's a leverage that as the market goes more and more towards physical demand, actual physical gold demand, physical buyers are not stupid. They go, I can buy it on the COMEX for $3,300, or I can buy it all in, including my capital cost, for $2,000 an ounce. That means I can pay $200, $300, $400 per ounce in the ground resource, including my capital cost. Even if it's $2,400 all in, it's still an amazing value. So you're going to see these resources in a bull market, which I think we're getting into. You're going to see dramatic increases in the per ounce in the ground valuations of the companies. This is very important to say, of the companies actually have a chance of becoming a producer. So I've made this point in other interviews before. Per ounce valuations don't really matter to me that much. You can tell my company's trading at $5 an ounce in the ground. If I assess that your project has no chance ever of coming into production, then you're not really worth anything. But I try to focus on companies that have a potential in the next cycle to be producing assets. Those are the assets you're going to see massive increases in per ounce. And if you're trading, you go from $10 an ounce in the ground to $150 an ounce on the ground, that's 15 times your money, right? So that's the kind of leverage that you can see. And again, with the gold prices that we are trading at today, that price is still extremely attractive for a producer. If you can spot the assets that have true potential to become producing mines, there's some incredible value in the sector today.
Yeah, some incredible value based on the multiple expansion, of course, also just exploration potential, development potential there. Very interesting space to be a part of. Are you also seeing a fat pitch currently in silver as a commodity?
So silver, I've talked a bit about that. Silver is different than gold. So gold is money. Silver, they call it poor man's gold for a reason, right? So if you're a central bank, you cannot say, like the Chinese have bought, I think, 600 billion worth of gold the last 2 or 3 years. That's just what they publicly disclose. I think they're buying a lot more they don't talk about. But if you want to buy 600 billion of silver, you'd need, 250 European soccer pitches full of silver to store it, right? So you wouldn't be able to physically store that amount of silver. So when does silver get going? Silver is an excellent proxy for me for retail mainstream participation in the gold market. And so we started to see silver break out recently, getting to potentially 52-week highs, $36, $37 an ounce. And concurrently, you've seen the junior resource stocks finally wake up from a 4 to 5 year slumber. So to me, silver is a proxy when gold buying goes from central banks and large hedge funds or large financial institutions to Main Street, that's when silver starts to go. So to me, the move in silver is very, very positive, because you're starting to see the early embers of broadening retail interest or broadening mainstream interest in the sector. So if you believe that your YouTube channel is going to have 5 times the viewers it has today that it had last year, because retail is going to get involved and they're going to be more and more interest in taxi drivers and Uber drivers that are talking about gold stocks, silver could have an explosive move. But you really need that retail mainstream participation. And that's also very, very positive for the junior resource sector. You can look at those ratios between gold and silver. That's also a good proxy. That does say silver is cheap, but people have been disappointed in silver the last few years because they haven't realized that the driver of silver is not central bank buying. It's not really the price of gold. It's the interest of retail and mainstream investors, which I believe strongly is coming. But that's your tell.
Great. And talking about silver as a commodity outside of a form of money, for example, defense applications and solar panels, is that something that you're interested in? Do you see a supply-demand opportunity there, or is that not really in scope?
I think I hear that a lot, given the above ground silver that we have stacked around the world, I don't believe so much in that thesis, to be honest. It's a nice to have. And the silver bulls that propose that also forget that if you want to tie to industrial demand, then you're going to also be more like copper. And so when the economy rolls over or things slow down, then you're more vulnerable. I think the best case, again, like I said earlier, for silver investors is that gold is money, goes mainstream. That's where you're going to see a tsunami of additional demand, and that's what's really going to drive silver price cycles. I think that narrative really is what silver bulls tell themselves to keep them warm when it's cold outside. They really want to encourage themselves, but really to me, you want to see the mainstream investor getting excited about precious metals and gold is money. And silver is the move that's driven by that is going to dwarf any move from solar or semiconductors, other applications they have in the space.
Yeah, definitely. All right. And touching base on another industry that might be showing a fat pitch, oil and gas, or at least the energy sector, reportedly underinvestment in sustaining capex as well as exploration due to an EV thesis, due to governments holding it back. Is that something that you're seeing as well?
Great question. Oil and gas is my first love. So I started in the business following oil and gas from 1997 till the peak in 2014. So I have a lot of knowledge, a lot of affinity for that space. Since we launched Bastion Asset Management 3.5 years ago, we've been actually pretty neutral on oil. But I am warming up to it. So I'll say what happened in the past. We've had 2 or 3 hot wars in very important oil-producing countries, Russia and the Middle East, and oil's still been unable to trade up. So what's been happening? Really, you have excess OPEC supply. So OPEC has been kind of overhanging the market. You've had this incredible supply growth in the U.S., which has seen U.S. go from a major importing nation of oil to becoming again a powerhouse in terms of oil production and even being domestically secure with their own production. And you've had the rise of EVs, which have been sort of at the margin creating a lot of negative sentiment and at the margin eroding some of that oil demand. So it's been a pretty negative picture: excess OPEC supply, declining demand, and then ramping U.S. supply. I think the stars are aligning. There's so much negative sentiment in oil right now. It kind of reminds me of gold in 2011. It reminds me of almost what oil was in 1997. Nobody believes it can go higher. Everyone believes that demand is done. But you're starting to see a shift away in Europe and the U.S. away from these extremely positive green agendas. So less subsidies for EVs. The EV ramp that was going to magically remove all oil demand is much, much slower, and the curve is flattening out. So that's positive for demand. You're seeing demand is going to probably be higher than we thought. The U.S. oil shale production, which has been this miraculous move from 1 million barrels a day to 8 to 9 million barrels a day of oil, that is, in my view, topping out. So you're not going to see those huge gains in oil shale production. And at the same time, you're seeing, like I said, massive underinvestment. All the companies have gone to cash flow dividend distribution models. This is an industry that used to spend 150 to 250% of its annual cash flow every year to grow as fast as they could. They were borrowing money, issuing equity, grow. Now, if you're a company that spends more than the cash flow, your stock price is hammered and you're shot. You're not allowed to do that. Most of these companies are spending 50 to 80% of their cash flow in buybacks and dividends every year. So most of these companies have very limited ability to grow. The high quality shale locations are gone. So you're going to see, I think, declining North American production or flatlining North American production. And the lower the oil price goes, the less they spend on capex because they've already promised their investors dividends and buybacks. So yeah, I think that I am warming up to the space. My only hesitation has been the stocks have not been that cheap. You've got to kind of believe in higher oil prices to make money in these stocks, which I'm starting to believe is possible, high oil prices. But I like a setup where the stocks are pricing in even lower price when they're trading, and I believe the oil price is going to go higher. But long answer to your question, I am interested in spending more time on the space, but I still see much, much more value on a relative basis in the gold sector. But it is a sector as a contrarian that I will be allocating more time to in the future.
Very, very interesting to hear that overview there on oil and gas. Are you also willing to look into a bit more niche materials? There's a couple here that I wrote down, for example, graphite, titanium, oxides, manganese, apatites, phosphates. Are those things that you're willing to look at, or is that too much of a niche market where you're just not dipping your toes into?
Yeah, to me, the nichier the market, the less I like it. So I always look at the market size, and why is that? Lithium's a good example, right? So lithium was the hottest thing in the world 3 years ago. I publicly stayed away from it. I probably could have made a lot of money riding the boom up, but I'm much more of a long-term investor with kind of a 7 to 10 year horizon when I get involved in something. And so the problem with lithium that I felt was it wasn't geologically scarce, and it was a pretty small market. And so subtle moves in demand or supply can crush your market. Manganese, I think people are excited about antimony right now, but they're niche markets. Molybdenum had a huge move a few years ago, but when you go under the hood, if you're saying 1 or 2 mines coming on can add 20 to 30 or 40% of your global supply, you're in a very niche market, right? Whereas, gold and copper, these bigger markets, you can add 15 new mines. You're not going to really change the supply demand dynamic that much. So I like markets that are broad, big, liquid, and unaffected by 1 or 2 new mines coming on. Phosphate's a little different. I actually am very positive on phosphate. I'm involved in a company called Contrarian Phosphate. It's a fully permitted project in Quebec. But the reason there is that phosphate is a big, broad market. So it's not like one or two mines coming on are going to drive supply or demand in a very significant way. And second thing I would say would be the demand dynamics of EV vehicles have not filtered into phosphate. So phosphate's used mainly in food, and food is a major driver, slow and steady demand. So you have a really good baseline demand. But hard rock phosphate or igneous rock phosphate is very, very valuable in the EV food chain. And that's very, very important. And it hasn't gotten any attention. But phosphate slowly but surely has been making new highs, new 52-week highs, while lithium is making new lows. And why is that? It's because phosphate has excellent base demand, big, broad market, and you have demand enhancement. Kind of like we said about silver. You got some base demand and you got enhancing demand, right? And so we have here at Phosphates, you have this extra demand coming from EV vehicles. It's not being priced in a market that has a very broad, deep, well-balanced supply-demand picture. So the broader the market, the deeper it is, the more liquid it is. I prefer to invest in those commodities because you get a better sense of pricing. You talk about mining, from discovery to production, you can be anywhere from 5 to 25 years. So if you're buying a junior resource stock based on the price of manganese or antimony today, by the time your mine's in production, that supply-demand picture could be very, very different. And so these niche commodities have these wild swings, which makes it hard to do anything other than trade them. And I'm a much more long-term investor, almost like a private equity mentality, where I want to see these projects get fully developed and sold. And so I like the markets where I have a lot more visibility in that sense.
Yeah, and talking about the rationale behind following that story and continuing to invest while it's a success story, of course, it's being de-risked continuously, but it seems tough to keep investing even if a company is already at an all-time high. It might feel expensive along the way.
So my first mentor in the business told me, and it's very controversial advice at the time to me, or not controversial, but contrary advice to what you think. He said, Michael, the best time to buy a stock is when it's hitting a 52-week high. And I said, really? Don't you want to buy low and sell high? But he was talking about buying a growth business. Okay, and so he's saying if you had a growth, he said, told me he bought Costco when they had 3 stores. Okay, they had 3 stores in the U.S. And he said to himself, there could be a Costco everywhere in the U.S. And you know what? He was right. So he told me, he said, you know how many times Costco has hit a new 52-week high over the last 35 years? Pretty much every single year, every single month, probably over that period of time, right? So if you've got a business that is worth tens of billions of dollars and you bought it at 100 million and it's now $200 million, and they're confirming that there's now 3 stores, 10 stores, 20 stores, 50 stores, right? In that case, the best time to buy it is at a 52-week high because your thesis has been confirmed. It's been de-risked. And to a certain degree and not a certain degree, the same thing is true in the junior resource sector. If you buy a company and it has 3 or 4 drill holes and it's got a $10 million market cap and they go and drill 20 more holes and they confirm the resource is as big as you dreamed it to be, well, it's obviously going to make a new high. And if it's on its way to becoming a mine, it's going to make many, many new highs along the way. What's different in the junior resource sector is sometimes stocks go up on speculation, on hope, on excitement, and then it's not confirmed. So you got to be careful. But yes, some of the best stocks ever owned in the history of the market, Microsoft, Costco, Home Depot, Walmart, those stocks have all made hundreds, if not hundreds of thousands of new highs along the way. But to me, it's always, where's the market cap trading vis-a-vis the potential value at full value on a takeover, let's say, or on a fully valued situation for the market. So that's, yes, you can't be afraid to buy 52-week highs, but don't just buy them because they're at 52-week highs.
Perfect. Michael, thank you so much for your time. Is there anything you want the viewers to know, anything you want to plug?
I would just say that for your European viewers, I'm planning a European roadshow with 5 or 6 of my largest investments. That's going to be in October, likely from October 6th to 10th. So I'll have some more details on that, but being North American based, I'm often available in North America, but I'll be doing a European trip to introduce some of my companies to the European audience and meet some European investors as well. So I'll keep you up a loop on that, and happy to share the dates when they're locked down. Yeah,
where can people find out more? Your LinkedIn, where should they follow you?
Yeah, I don't have a social media profile myself. I do a lot of interviews like this, so you can look me up on YouTube, Google my name, or see me on YouTube. You'll see the interviews that I'm doing, and I'm also available on LinkedIn. That's the 2 places where I am typically active.
Perfect. Thank you so much, Michael.